Good morning, good afternoon, good evening. Welcome to our 2021 Q2 Global ACS webcast. I'm Gary Berchowitz, a partner in our global accounting team, and today I'm joined by my fellow partner from the global team, Kling. In this webcast, we'll focus on some topical issues: special purpose acquisition companies or SPACs, and specifically the pre-acquisition accounting considerations for these arrangements. We'll look at the cloud computing IFRIC agenda decision. And lastly, we'll look at gross cash flow presentation principles, specifically focused on supplier finance arrangements. Please feel free to use the timestamps in the description below the video if you want to go straight to one of the topics we're discussing today. Enjoy.
Okay, so let's get started with SPACs. But first, just a little bit of background on these SPAC transactions. So a special purpose acquisition company or SPAC is formed by a management team or a sponsor with nominal invested capital, generally referred to as founder shares. The SPAC then raises capital through an initial public offering with the intention of acquiring a private operating company or OpCo. When an OpCo is acquired by a publicly traded SPAC, it effectively becomes a public company without executing its own initial public offering. Now, the SPAC transactions are very complex, both in terms of accounting and regulatory requirements, and a careful analysis of all the facts is needed, and consultation with subject matter experts is also strongly encouraged. But let's dive into some of these accounting issues. So the accounting issues can be separated into pre and post acquisition issues. In our Q1 webcast, we covered the post acquisition issues. Today, what I'd like to do is focus on the pre acquisition issues. So those are the accounting considerations relating to the SPAC formation and IPO. Now, these areas include control. Does the sponsor control the SPAC? The accounting for founder shares and warrants. And the third area is the accounting for public shares and warrants. But let's start with control. Does the sponsor actually control the SPAC? Where SPACs are sponsored by corporate entities, an IFRS 10 control assessment will need to be performed to determine whether the sponsor has control over the SPAC. A sponsor controls the SPAC when the sponsor is exposed or has rights to variable returns from its involvement with the SPAC, and the sponsor has the ability to affect those returns through its power over the SPAC. If the sponsor controls the SPAC, the sponsor is then required to present consolidated financial statements, unless an exemption would be applicable. Now, a sponsor that does not consolidate a SPAC would then have to determine whether it needs to apply IAS 28, the equity method of accounting, because it has significant influence over the SPAC, or if not, whether it needs to apply IFRS 9 to its investment. What about founder shares and warrants? So in many cases, again, the SPAC will issue shares and warrants to its founders. So in the SPAC financial statements, a key consideration is whether the founder shares and warrants will be accounted for under IFRS 2, the share-based payment standard, or under IAS 32, the financial instrument standard. That determination will require careful considerations of all the features. Now, factors to consider in the analysis include, but are certainly not limited to, what is the commercial rationale for issuing the instruments to the founders? At what value are these instruments issued? For example, equity instruments of the SPAC that have been issued at a discount to fair value might bring those instruments within the scope of IFRS 2. Do the rights of those founders differ from those of the public shareholders? Are there any incentive mechanisms to increase the value of the founder shares? Those will all be important considerations. Now, the distinction between applying IFRS 2 and IAS 32 is important because the classification as debt or equity is different between IFRS 2 and IAS 32. So the outcome can be different depending on which standard applies. Now, we expect that the founder shares and warrants will in many cases be within the scope of IFRS 2. And when IFRS 2 applies, careful consideration will then need to be given to the grant date under IFRS 2. So let's move on to the public shares and warrants. In the SPAC's financial statements, the shares and warrants issued to the public investor, will generally be accounted for applying IAS 32. And that's because transactions with shareholders acting in their capacity as shareholders are outside of the scope of IFRS 2. However, the classification of public shares and warrants as equity and liability will still require careful considerations of all the features in the agreement. And that includes put features that can be present in the shares, or potential variability in the strike price or the number of shares for the warrants. But let's take a closer look at the public shares. So the public shares may actually contain an obligation to redeem in particular circumstances, typically the outcome of the acquisition. Such redemption features or put options will generally prevent the instrument from being classified as equity, resulting in liability classification. However, equity classification might result if the redemption rate is within the control of the SPAC, and the SPAC, as a result, has an unconditional right to avoid paying cash. So here, it will be really important to understand the role of the SPAC shareholders and whether they're acting on behalf of the entity or not. What about the public warrants? The public warrants are derivative instruments and need to be assessed under IAS 32. Now, under IAS 32, equity classification for warrants will arise only if the warrants will be settled by the SPAC delivering a fixed number of its own equity instruments in exchange for a fixed amount of cash. In many instances, there are features in those warrants that violate this fixed for fixed requirement in IAS 32. This then results in financial liability classification for the warrant. So an example is just a net share settlement feature, for example. So those are the key considerations at a high level. I hope this session was helpful. If you do have further questions, please go read our in-depth on SPACs. We have a number of frequently asked questions linked to the document that will be helpful in navigating some of these key considerations. Thank you.
Cloud computing is a model for delivering information technology services through web-based tools and applications. Now, in SaaS or software as a service contracts, the customer generally does not obtain a software license or have a right to take possession of the software. The access to the software is a service that the customer receives over the contract term. The software typically remains on the seller's hardware, and the buyer would only access the software via an internet connection. Now, capitalization of costs under previous IT models was the norm. However, in this new world of cloud, there are questions about what can be capitalized and what can't. Some would say that the IT model looks much more like a service model under a cloud arrangement. So there are a lot of doubts about what can be capitalized, and it's a concern for many entities as they incur significant costs in relation to this to bring their systems up to date. There is also an implication to presentation, because in the past, the expense for an in-house IT solution would have been depreciation and amortization. In a SaaS arrangement, though, if no costs are capitalized, the expense would not be presented as depreciation or amortization, which in turn might have an impact on key metrics such as EBITDA. Entities transitioning to SaaS solutions or cloud computing is a topical issue. There was a submission about the accounting for SaaS arrangements more generally in March 2019 to the IFRS Interpretations Committee, and in March of this year, there was an agenda decision about specifically the customization and configuration costs. I think for the rest of this session, I'm just going to call them the CCs, because otherwise it's quite a mouthful. Now, the IFRS IC issued an agenda decision on the treatment of SaaS arrangements in March 2019, as I mentioned, and this previous agenda decision considered the accounting for SaaS arrangements as a whole and whether or not they could be an intangible asset. Now, the conclusion in that agenda decision was that generally SaaS arrangements would not result in an asset because the buyer does not control the IT being provided. Now, in this latest agenda decision, the IFRS Interpretations Committee has focused solely on the treatment of customization and or configuration costs, or CC costs, which are normally substantial and they're incurred upfront. I think before we chat about this, it's really important to note that the ISP staff define CC costs quite specifically, and the principles in the agenda decision might apply to only those types of costs. We've reproduced the definitions considered by the IFRS IC on the slide for you to take a look at. And this is critical because entities would need to think about what material upfront costs they incurred, and many of these costs might go beyond the narrow definition that the IFRS IC was looking at. So for example, in some cases, these upfront costs could represent additional bespoke software that the entity develops to interact with the SaaS service. And any bespoke software developed and controlled by the entity would normally be capitalized as an intangible asset, similar to other on-premise software. Right, so assuming we're talking about costs that represent the CC costs as defined by the committee, we think that there are three parties that could do the CC. The entity could do it using its own employees, the SaaS provider could do it, or a third party could do it. And it's important to identify which party performs the CC as it impacts the accounting thought process as follows. Right, so if the entity configures or customizes the SaaS themselves, then you would need to consider whether or not those activities met the definition of an intangible asset and complied with the capitalization criteria in IAS 38. And based on the way that CC activities were defined, the committee said it would be unlikely that they would meet the definition of an intangible asset. So more likely you would be expensing those costs. If the SaaS provider configures or customizes the SaaS, you would ask that first same question, so whether or not those activities met the definition of an intangible asset, and the capitalization criteria would be deemed to be met because you're making a payment to a third party. However, if those activities did not meet the definition of an intangible asset, then you need to ask yourself whether or not the configuration and customization services are distinct from the SaaS arrangement. And if they are distinct from the SaaS arrangement, then they would just be recognized as an expense as incurred. However, if they are not distinct from the SaaS arrangement, they may be deemed to be a prepayment for the SaaS service, in which case, like all prepayments, you would capitalize them and recognize them over the related SaaS term. And finally, if a third party configures or customizes the SaaS, you start out again asking the question whether or not those activities meet the definition of an intangible asset. Again, based on the way CC was defined, it's unlikely they would. But if they are, then you capitalize them. If they do not meet the definition of an intangible asset, you need to ask yourself whether or not that third party is actually a subcontractor working at the behest of the SaaS provider. If the answer to that is yes, you do the same analysis that we just spoke about for the SaaS provider. If, however, the third party is not acting as a subcontractor for the SaaS provider, then you will generally expense the configuration as they are incurred. The agenda decision was part of the March IFRS Interpretations Committee meeting and was ratified by the board at the end of April. Now, as with all agenda decisions, it's applied retrospectively, but entities would be entitled to a sufficient amount of time to make the change. Any change to the amounts recognized in the financial statements should be applied retrospectively. Therefore, comparative amounts might also need to be restated. Any material change in the financial statements as a result of entities reconsidering their accounting should be disclosed in a transparent way as always and comply with IAS 8. Now, I suspect that most entities that have a June reporting period would not yet have had the chance to consider all of the requirements and obtain the information necessary to reconsider any previous accounting treatments. However, entities should make it clear in their financial statements what they think the implications of the agenda decision might be for them and where they are in their analysis. And if you haven't completed your assessment by the time you report your June numbers, we'd recommend that if you're affected, you ensure that you start the process to make sure you're ready to report any changes as soon as reasonably possible. So what are the things folks might want to remember for setup costs in a SaaS arrangement? Well, number one, think about all the costs incurred in a SaaS setup. Many of these material costs might be broader than CC as defined, and they might still qualify for capitalization. Number two, it's quite difficult to capitalize CC as defined as an intangible asset, but make sure you also consider if those activities or costs might represent a prepayment. And in doing that, understanding the party that performs the CC can affect that accounting analysis. And lastly, if you've capitalized significant setup costs as part of an ongoing SaaS arrangement, please start the process now of looking carefully at what you've done and if any changes are needed. In December 2020, the IFRS IC issued an agenda decision on supplier finance arrangements. In our 2021 Q1 webcast, we covered the specific areas addressed by that agenda decision. And today I'd like to focus on the treatment specifically of cash flows incurred on behalf of the entity, and on the principle that could be applied across all arrangements to determine if an entity should record a cash flow in the cash flow statement when that cash flow might not be reflected in the entity's bank account. As part of the 2020 agenda decision, the IFRS IC included a section on the treatment of cash flows for supplier finance arrangements. And the agenda decision included guidance in relation to determining an entity's cash flows, which we've reproduced on the slide. The important bit here is that the IFRS IC said that if a cash inflow and outflow occur for an entity when an invoice is factored. And I think the important thing here is that if, because there's no explanation of how to determine if a cash flow has actually occurred in the agenda decision. A reporting entity might enter into an arrangement with a third party to make payments on its behalf. For example, in a business combination, the reporting entity might take out a loan to finance the acquisition of that business and instruct the bank to pay the seller directly. Now, in that case, even though the bank might make the payment directly to the seller of the business, the entity would generally still reflect an investing cash outflow to the seller and a corresponding financing cash inflow from the bank, even though the entity might not have received the cash inflow and outflow in its actual bank account. Now, more commonly, this type of analysis might need to be considered in a supplier finance arrangement, in which the reporting entity might be instructing the bank to pay the supplier on its behalf. Now, the question that arises in a supplier financing arrangement is whether to present payments made to the supplier by the bank in the cash flow statement of the reporting entity. That is, to present a gross cash flow before the cash flow from the entity to the bank. Now, as with most difficult things related to accounting, judgment is required to determine whether another entity is acting as a payment agent and making and receiving payments on the reporting entity's behalf. Now, we think an appropriate principle is to consider a cash flow occurring for the reporting entity when that entity has the ability to direct the cash to or from a third party, and the entity controls the timing and amount of the cash payment made to or from a third party. If a cash flow occurs for the reporting entity, then this is presented in the cash flow statement, regardless of whether the cash actually flows through the entity's bank account. If the reporting entity does not have the ability to direct the timing or amount of the cash flow to a third party, then the settlement of the transaction is a non-cash transaction and it would not be reported in the cash flow statement. So, for example, a reporting entity might be able to settle a liability to a lender by transferring a receivable from a third-party debtor to the lender. In that case, the reporting entity is transferring only a right to receive cash, and this would generally not be considered as a cash flow controlled by the entity. However, if the reporting entity instructs the third-party debtor to send cash to the lender rather than themselves, the entity would generally reflect the cash inflow and cash outflow for the transaction, as the right to receive cash has been exercised and then the cash has been directed to the lender at the entity's behest. Now, this is quite tricky, and we plan to issue some guidance in the future which might be helpful to entities in making these types of judgments.